So today we'll be looking at the concept of intergroup transaction. After we have acquired a subsidiary, there is a possibility that there will be some transaction which occur between the parent company and the subsidiary company, and we'll be looking at such transaction that we may have in that case. So when we have a subsidiary and the parent company, intergroup transaction can occur in so many ways, and it can lead to the following. And the first one is intergroup current account. Intergroup current account happens where the parent and subsidiary are trading together, and there is a possibility that one will be owing the other, leading to a receivable in one's account and payable in the other's account. So if parent is selling to the subsidiary, the parent can have a receivable while the subsidiary will have payable, and other case can also be the case, which means the subsidiary can also be selling to the parent company. So in such case, we will have intragroup current account where we have to reconcile our receivable and our intragroup payables. Another one we can have is unrealized profit on intergroup sales of inventory. We said that whenever we are in a group together, the parent and the subsidiary, they are seen as one single company, and as such you cannot make profit from yourself. So which means if the parent company is selling to the subsidiary company, the parent company is not expected to make profit from the subsidiary. Same thing too, if the subsidiary company is actually selling to the parent company, they are not expected to make profit from themselves. The only profit that will be recognized in the group account is only the profit generated from the third party. So in this case, when we trade with ourselves and the good is still part of our inventory at the end of the year, it may result to unrealized profit. Another one we'll be looking at is unrealized profit on the sales of PPE. So when there is intra-group exchange of PPE, whereby the parent sells to the subsidiary or the subsidiary sells to the parent company, there is a possibility that the seller will actually sell at a price that is not the cost price to the group. And since we are the same thing in a group, we are expected to exchange PPE at cost. So because of the fact that we exchange the PPE at a price that is higher than the cost, automatically we have to make adjustment to our account. So in such case, depreciation would definitely be different. The parent can sell to the subsidiary or the subsidiary can sell to the parent, but mostly it won't be at the cost price. Yes, so if I'm selling to you at a price that is higher than the cost price, automatically to compute your depreciation, you are going to use the amount you got that asset to calculate your depreciation. As such, the depreciation you calculate to the group is not a true representation of the actual depreciation we're supposed to have in the group account. As such, there are some adjustments we have to make when we have intra-group exchange of PPE. Another one that we can have is loan held by one of the company in the other. It is possible that the parent company will definitely give loan to the subsidiary company, and in some cases the subsidiary companies too can also give loan to the parent company. If such happen, how do we account for it in our group account? Don't forget, the parent and the subsidiary are seen as a single entity when preparing group account. As such, what do we do to that? And another thing that we have to look at is the intragroup dividend and loan notes. Because the parent and the subsidiary, they are the same group, how do we treat dividend? And when we give loan, how do we account for the loan interest? These are the 5 basic things we will be looking at under intragroup transaction. But in today's video, we will be looking at majorly on intragroup current account and loan held by one of the company in the other, whereas the remaining 3 will be checked in our subsequent video. Now let us start with how to account for intragroup current account. As explained earlier, I said intragroup current account happens when the parent company and the subsidiary company are trading together, and when they are trading together, there is a possibility that there will be receivable in one of the company and there will be definitely be payable in the other company, except if one of them pay by cash for every transaction that occur. So what will happen in that case? If there is intra-group payable, now there is payable in one company. If you are owing you 100 million, automatically the receivable in the other company must definitely be equal. So if the parent claim that the subsidiary is owing 100 million in the subsidiary account, so if we check, the payable will be reading 100 million. And as such, what do we do when we have something like that? Very easy and straight. You just have to eliminate it. By the time you are consolidating, you remove 100 million from the receivables account and you remove 100 million from the payables account, and you are cool. But is it possible that both of them will not be equal? So it is possible that I have intra-group payables and receivable not to be equal. So what will I do if both of them are not equal? Maybe our receivable is more than our payable, or anyhow. In that case, what I still have to do is simple. I have to eliminate the amount from the receivable and I eliminate the amount in the payable. For example, now we can be given that the trade receivable reads 100 million while the trade payable reads 60 million. What I need to do is simple. I remove 100 million from the receivables, I remove 60 million from the payables, but there is a difference of 40 million. What will happen? The difference, when there is a difference between your intra-group payable and your intra-group receivable, it can be as a result of two things, and the first one is what we call cash in transit. For example, now maybe the subsidiary is owing the parent company money, and as at the end of a particular business day they send money through the bank. Since I send money through my bank, I will recognize the money I sent, so which means that I am going to reduce my liability. So I reduce my liability. Maybe I sent 40 million, I reduce my liability from 100 million to 60 million because I've sent you cash of 40 million already. Whereas in the parent account, the 40 million has not been received. What will happen? They will still recognize 100 million. So in such case, it means that the 40 million is a cash in what? Transit. And it is also possible that we have what we call inventory in transit. So inventory in transit is the sense that maybe let us assume both of them are owing themselves 100 million, 100 million. But the parent company decide to send more goods to the subsidiary company. They now send goods of 50 million. Now they will recognize it that the subsidiary is owing them additional 50 million, which makes their receivables to be 150 million. But let us assume that as at that day we want to prepare our account, the subsidiary is yet to receive the goods of 50 million. The subsidiary will still recognize payables of 100 million instead of 150 million, and as such the receivables and payables may not be the same. Now what do we now do? Whenever there is cash in transit and you are preparing your consolidated statement of financial position, you add the cash in transit to your cash. And whenever there is inventory in transit and you are preparing consolidated statement of financial position, what do? You add the inventory in transit to your inventory, and automatically that is the end of intra-group current account. And another one we will be looking at in today's video is loan held by one of the company in the other. So as part of the investment of the parent, it is possible that the parent company will also have part of the loan note in the subsidiary, or the subsidiary can even give the parent some loan. So in that case, what will happen? So we look at the giver can be the parent, it can be the subsidiary. At the same time, we look at the receiver. It is very easy. What do? From the giver's account, let us assume that the parent is the giver now. It means that if I have a loan note in another company, it is an investment to me as the giver. What will I do? What I will do is very easy. It is part of my investment, but because of the fact that the giver and the receiver are within the group, I have to eliminate it from my investment. So after eliminating it from my investment, from the giver's perspective, What about the receiver's perspective? That money from the receiver's perspective is definitely part of the loan note. The same amount will also be eliminated from the receiver's loan note, which make our account balance. Very easy and straight. So let us now look at work example to explain this concept deeply. So question 1 says Romeo acquires 75% of the equity share capital of Juliet Limited for $550 million 2 years ago, when the retained earnings and share premium of Juliet stood at $150 million. Romeo again invested in 65% of the 10% loan note in Juliet. Statement of financial position as at 31st December 2019 is as follows, and all figures assumed to be correct. We go to the additional note. The additional note reads, Romeo measures non-controlling interest using fair value basis, and the fair value of NCI is estimated to be $200 million. 2. Romeo's trade receivable at the year end include $100 million due from Juliet. These include goods of $15 million that had been dispatched by Romeo on the last day prior to the year end, but had not arrived at Juliet by the year end. 3. Juliet trade payable at the year end includes $60 million due to Romeo. This was after the deduction of $25 million in respect of cash sent by Juliet on the last day prior to the year end, but had not arrived at Romeo by the year end. So we are required to prepare the consolidated statement of financial position as at 31st December 2019 for Romeo Limited. So we go to our solution, and based on our previous video we said we have 5 basic workings, which is the determination of our group structure, or what we call control. We determine the net asset of the subsidiary, we calculate the goodwill, we determine the non-controlling interest, and finally we calculate our retained earnings. So let us start with this question. To determine our group structure is kindly very easy in this question, because we are told here that Romeo acquires 75% of the equity share of Juliet. So which means that Romeo has 75% of Juliet, and we know that the portion that is not owned by the parent company belongs to the non-controlling interest, and in this case my non-controlling interest will definitely be 25%. That one is very easy. And when did we acquire this subsidiary? We acquired this subsidiary 2 years ago, and I told you, you must always take cognizance of when we actually acquire a subsidiary in case there is fair value adjustment. So we move to workings 2, which is to determine the net asset of subsidiary. At the date of reporting, I will come to my account here. My ordinary shares of the subsidiary, which is Juliet, is 200 there. I'll pick the share premium, which is 150, and I'll also pick the retained earnings, which is 350, giving me my net asset at the date of reporting to be $700 million. Now, what happened at the date of acquisition? Coming back to the first paragraph of the question, the first paragraph of the question said something. It said, when the retained earnings and share premium of Juliet stood at $150 million. So coming here now, at the date of acquisition, my share premium is $150 million, my retained earnings is $150. But don't forget, since the time we acquired this company, there is nothing like we issue additional shares. So our shares at the date of acquisition and at the date of reporting remain the same. And as I said before, what is your post-acquisition profit? Your post-acquisition is the difference between your date of reporting and your date of acquisition. So if I less this from this, I will get 200. So my net asset at the date of acquisition is 500. So my post-acquisition profit is 200. So workings 3 now, which is the determination of goodwill. Now, to determine goodwill, I need the fair value of consideration transferred by parents. And in this question, it is quite straightforward because we are given free of charge, unlike our previous video where we have to calculate it ourselves. So in this case, we are told that Romeo acquires 75% of the equity share in Juliet for $550 million. So we are given, so I will come here, this is the $550 million. I need to add my non-controlling interest. The examiner don't even want to stress us in this question, and we are also given non-controlling interest free of charge. I told you in my last class that there is a way you can determine your non-controlling interest in case you are not given. So if you missed the last lecture, you can definitely watch the video on how to calculate your non-controlling interest. So in this case, I have 200, and where am I picking my 200 from? I can go to my additional information 1, whereas we are told that NCI is estimated to be 200 million. So coming here give me a total of 750, and we less the net asset of subsidiary at the date of acquisition. Now coming back to my workings too, my net asset at the date of acquisition is 500 million. So lessen my 500 million here, give me my goodwill to be 250. When I have my goodwill to be 250, I will definitely check for impairment. But in this question, there is no impairment. And if there is no impairment, what happened? We can definitely move on. So we go to note 4, which is the determination of non-controlling interest. And simple, we said as given to us here, I will bring it down, same figure here, I will bring the same figure here, which is 200. Now we are told at the beginning of this question that the parent owns 75% of this business. Automatically NCI owned 25%. So the post-acquisition profit in line with workings 2 is 200 million. So my post-acquisition profit that the NCI is entitled to is going to be 25% of 200, which give me 50. And adding it together, my NCI at the end of the year should be 250. After that, what do? We have to compute our retained earnings. And like I said in my previous video, that retained earnings can sometimes be called parent retained earnings or group retained earnings, but I prefer using the word retained earnings. Now I will start with my balance brought forward. Balance brought forward I will be taken from the statement of financial position. Coming to the equity aspect, what is the retained earnings of the parent company? As given to us, the retained earnings of the parent company is 450, and as such, coming here we have 450, and after that we have post-acquisition profit, which is 75% times 200, because the parent owns 75% of this business, which give me a total of 150. And at the end of the year, we are going to have our retained earnings to be consolidated to be 600. So, and another thing we have to look at in this question, we have to look at our current account. Now additional information 2 and 3 is talking about something, and let us go through it. Additional information 2 says Romeo trade receivable at the year end include 100 million due from Juliet. Like I explained, I said it is possible that the parent company and the subsidiary company will be trading together, and as such we can have intra-group payables and receivables. So in this case, we are told that Romeo trade receivable include 100 million. So I will come to this place, this is the 100 million. But coming to additional note 3, we are told that Juliet trade payable include 60 million. Now I said the payables and the receivables are expected to always be the same, but in this case receivables is 100, payable is 60. There is a problem because the difference is 40, and I explained earlier that the difference in your current account can be as a result of two things. It can either be as a result of inventory in transit or cash in transit. Let us investigate this difference. Coming back to my additional note 2, we are told that this include goods of 15 million that had been dispatched by Romeo on the last day prior to the year end. So which means Romeo, which is the parent, actually dispatched a good which is 15 million, but as at the year end that goods has not been received by Juliet. So automatically that is our inventory in transit. So my inventory in transit is 15 million. If I check again my additional note 3, we are told again that this was after the deduction of 25 million in respect of cash sent by Juliet on the last day prior to the year end, but had not arrived at Romeo by the year end. So what is that? I sent money at the year end, but as at the day we are preparing this account, that money has not gotten to the parent company. That is what we call cash in transit. So the cash in transit is 25 million, and if you add both together, it will give you that discrepancy, which is 40 million, and you can see that my current account will definitely always be zero. Now that we are done with the required calculation in this question, let us now go to the main part, which is the consolidated statement of financial position, and let us see how it is going to look like. We start with the non-current assets. The parent company plant and machinery is 600, Juliet is 400. Coming year I have 600 plus 400, which give me a total of 1000. I go to furniture and fitting, which is 450 and 250. 450 and 250 give me 700. Now I come to investment. Let me quickly chip in something here. From our previous videos, we have been looking at investments in the subsidiary as the only investment that is owned and controlled by the parent company. But it is possible that the parent company owns more than the investment in the subsidiary alone, and this is a case like that. We are told that the total investment is 950. Don't forget, the investment in the subsidiary will definitely be eliminated, which we all know. Now, if I have 950 here, we are told at the beginning of this question here that Romeo acquires 75% of the equity share capital of Juliet Limited for 550 million. So which means from the investment I will remove that 550 million. Now don't forget, they said something again. They said Romeo again invested in 65% of the 10% loan stock in Juliet. So which means that the loan stock in Juliet, the parent company owns 75% of that. And don't forget, the parent company cannot actually in real sense invest in the subsidiary because they are seen as one company. So as such, we have to remove 65% of the loan note of the subsidiary from this investment. Now I will come and check. The loan note of the subsidiary is 300, and we are told that Romeo is the one that owns 65% of this 300. As such, we have to eliminate that. So 65% of 300, eliminating it from the invest, it means that the remaining investment of 205 will be the only one that will be consolidated. So which means that 205 are the investment owned by the parent company out of the group. So the next one is goodwill. As calculated in our note 3, our goodwill is 250, and as such we bring it in. My goodwill in note 3 is 250, giving me my total non-current asset to be 2155. We can then go to our current asset. I will start here. Inventory as given to us here is 250 and 150. 250 and 150. Don't forget, I said whenever we have inventory in transit, whenever you are consolidating, you add it to your inventory. And whenever you have cash in transit, whenever you are consolidating, you add it to your cash. So what I'm doing now, as calculated earlier in note 6, my inventory in transit is 15. So I have to consolidate it here, giving me a total of 415. Same thing too, I will go to my receivable, which is 400 here and 300 here. So 400 and 300. Don't forget, what is the rule? Eliminate the intra-group receivables and eliminate the intra-group payables. So I will eliminate the 100 here because we are told in our current account, which is our note 6. Let me go back. So in my note 6, the intra-group receivable is 100, and as such I have to eliminate 100. And when I get to payables, I have to eliminate 60, which is very easy as explained earlier. So coming here now, I eliminate the 100, giving me a total of 600. I then go to cash at bank. As given in the question, we have 150 and 120. So 150 plus 120, don't forget, we have cash in transit, which is 25 million. Adding my cash in transit of 25 million here, give me a total of 295. And I can get my total current assets to be 1,310. So, and my total assets to be 3,465 million. Very easy and straight. So we can then move forward to check the equity aspect of this question. I told you I'd like to emphasize this in every video. Whenever you are consolidating, you don't consolidate the equity of the subsidiary. The only thing we consolidate is the equity of the parent company. As such, ordinary shares in this question is 1,000 and I bring it in. Same thing, share premium here is 200 and I bring it in, which is 200. Don't forget, we calculated our retained earnings in note 5 above and we got 600. So adding all this together, we are going to have 1,800. So I need to add my non-controlling interest in line with note 4. And according to note 4, we calculated our NCI to be 250, giving me my total equity of 2,050, and that is the end of equity. So I can then move to liabilities. So under non-current liabilities, we are given in this question that 10% loan note in the parent is 400, while in the subsidiary is 300. 400 plus 300 give us 700. But don't forget, I said whenever we have intra-group loan, we have to eliminate it from the investment and also eliminate it from the loan note, and which can be seen here. We eliminated the 65% of the 300 away here. So same thing, we have to eliminate 65% of the 300 here. And why are we doing that? Because that loan is within the group, and as such, when we are preparing group accounts, we cannot borrow ourselves money, so we have to eliminate that again. So I eliminate 65% times 300. So at the end, the total 10% loan notes that will be consolidated is 505. So I can then move to current liabilities. As given to us in this question, we are told that payable is 400 and 220. So coming here, 400 plus 220. Don't forget, there is intra-group payable in this question, and the intra-group payables according to our current account is given to be 60 million. So 400 plus 220 minus 60 million will definitely give me a total of 560 million. Very easy. And the last one in this question, which is accruals, the only accruals we have is 350 plus 0, which gives me a total of 350. Adding my current liability together, I am going to get 910. So adding my total liability, which is 505 and 910, give me 1,415, which then give us the total equity and liability to be 3,465. And you can see that at the end of the question, our account definitely balanced. It is a principle that is very easy, but we have to follow the steps. Thank you for watching. Try to share, subscribe, and turn on the notification button. Thank you.